In November 1923, a loaf of bread in Berlin cost 200 billion marks. Not because the bread had changed, but because the money had. In that same year, the German mark lost more than 99% of its purchasing power in a matter of months. Wages were paid twice per day. Prices changed between the time a customer entered a shop and the time they reached the counter. These moments are often remembered as extreme, but in financial history, they are not unique. From Europe in the early 20th century to Latin America in the late 20th century to several modern economies, currency collapses have followed recognizable patterns, and in each case, the same question quietly reappears. When money fails, what continues to hold value? This is Archive Financial, where money, power, and history collide. For most people, money feels permanent. Bank balances, salaries, and prices appear stable from year to year. But history shows that currency systems are not permanent institutions. They are policy frameworks maintained by confidence, law, and economic capacity. When that framework weakens, the consequences are not limited to exchange rates. They affect savings, contracts, wages, and the structure of everyday economic life. Understanding which forms of value historically persisted and which consistently failed is not about predicting crises. It is about recognizing how monetary systems have behaved across time and across countries. Modern currency collapses share common features, even when they unfold in very different political and cultural settings. While each case is shaped by its own circumstances, the underlying monetary mechanics often follow a familiar path. In the early 1920s, Germany faced a combination of post-war reparations, fiscal strain, and political instability. Government expenditures far exceeded revenues, and traditional financing options were limited. To meet its obligations, the state increasingly relied on expanding the money supply. As more currency entered circulation, prices began to rise rapidly. With each increase, public confidence weakened, accelerating the decline in purchasing power and reinforcing the cycle. A similar dynamic emerged decades later in Zimbabwe during the late 2000s. Severe fiscal imbalances, combined with declining agricultural and industrial production, reduced the economy's capacity to generate real output. To cover spending gaps, authorities resorted to large-scale money creation. Inflation escalated dramatically, eventually reaching levels where prices changed multiple times within a single day. In Venezuela, prolonged economic contraction, falling oil revenues, and persistent budget deficits contributed to sustained currency depreciation. Monetization of government spending increased the supply of currency without a corresponding increase in goods and services, eroding purchasing power over time. In Lebanon, stresses within the banking system and mounting fiscal constraints undermined the exchange rate regime, leading to a sharp loss of confidence in the currency. These episodes differed in their immediate causes and time, yet the sequence often followed a similar structure. Rising fiscal pressure, expansion of the money supply, declining confidence, and rapid changes in the real value of money. What ultimately changed was not only the level of prices. What changed was which forms of value continued to function within the economy and which no longer did. Currency functions primarily as a unit of account. It provides a common measure for pricing goods, services, wages, and debts. But it is not value itself. Value depends on what currency can command in real terms, not on the number of units recorded on a balance sheet. Most financial contracts are written in nominal terms. A bank deposit promises a fixed quantity of currency units. A government bond promises a predetermined stream of payments denominated in that same currency. These obligations are legally defined by numbers, not by purchasing power. When inflation accelerates, those numbers do not change. The units remain exactly as specified in the contract. What changes is what those units can buy. As prices rise, each unit of currency represents a smaller share of real goods and services. This creates a structural distinction that becomes critical during periods of monetary stress. Nominal value remains intact, while real value edges soften sharply. A simple analogy illustrates the mechanism. If a contract promises 100 units of currency payable in 10 years, that promise will be fulfilled regardless of whether those units purchase a week of groceries or a single loaf of bread. The legal obligation is honored in full. The economic substance of the agreement, however, has been transformed. This distinction explains why inflation can operate as a quiet reallocation mechanism. It does not require defaults, missed payments, or formal renegotiation of contracts. Instead, it alters the real meaning of existing obligations through changes in the price level. Creditors receive what they were promised in nominal terms, but not necessarily what they expected in purchasing power. In historical currency collapses, this gap between nominal and real value becomes central. Assets and claims that depend on fixed currency units often deteriorate rapidly in real terms, while forms of value less tied to nominal contracts tend to remain functional. Across historical currency collapses, certain forms of value have tended to remain functional longer than others. These outcomes were not guaranteed, and they were rarely smooth. But when examined across cases, recurring forces emerge across monetary disruptions. Precious metals, particularly gold, have repeatedly maintained purchasing power relative to collapsing currencies. In Weimar Germany, gold prices rose broadly in line with inflation as the mark depreciated. In Zimbabwe and Venezuela, gold retained value when measured against local currencies that were rapidly losing credibility. This did not mean gold prices were stable. In many episodes, nominal prices fluctuated sharply, sometimes declining temporarily during periods of forced liquidation or restricted markets. Short-term volatility was common, but across collapses, gold's role as a unit of value outside the domestic monetary system allowed it to preserve real purchasing power over time. Gold did not depend on the credibility of local fiscal authorities or domestic banking systems. It was not a promise issued by the state. That structural independence is what mattered. Its value was not immune to disruption, but it was less directly tied to the mechanisms driving currency depreciation. The pattern appears consistently across cases, though never without periods of instability. In many historical episodes, populations shifted toward foreign currencies during periods of domestic monetary stress. In Lebanon, US dollars became a common medium of exchange for wages, rents, and basic transactions. In Zimbabwe, dollarization emerged informally before it was later recognized in policy. In Argentina, property transactions and large contracts were often denominated in foreign currencies, despite legal tender laws. This shift was not solely a government decision. It reflected decentralized responses to currency risk. When domestic units lost reliability as stores of value and units of account, economic actors sought alternatives that better preserved purchasing power. Foreign currencies did not eliminate economic hardship. They did not restore growth or fix underlying fiscal problems. But historically, they provided a relatively stable reference point when domestic currency credibility declined. Currency substitution, when it occurred, signaled not just inflation but a breakdown in confidence in the domestic monetary framework itself. Ownership in productive enterprises has shown more complex behavior during currency collapses. In several hyperinflationary episodes, stock market indices rose sharply in nominal terms. This was not necessarily evidence of economic recovery. In many cases, it reflected the repricing of real assets in rapidly depreciating currency. The critical distinction was firm structure. Companies with access to foreign revenues, export markets, or hard currency pricing often adjusted more effectively. Their costs and revenues did not move in lockstep with domestic inflation. Firms fully dependent on local purchasing power faced tighter constraints, even if their nominal valuations rose. Ownership in productive capacity factories, logistics networks, distribution channels, and international trade relationships sometimes retained relative value, but outcomes varied widely between sectors and firms. Historically, the survival of equities depended less on market participation itself, and more on the underlying structure of the business being owned. No asset class is immune to systemic disruption. Precious metals can experience sharp volatility and periods of underperformance. Foreign currencies introduce political and policy risk from other jurisdictions. Equities depend on regulatory environments, taxation, and capital controls. Physical goods and commodities may hold short-term utility, but they are not scalable financial instruments. Real estate and land may retain long-term value, but face liquidity, taxation, and legal risks. History shows that preservation of value during currency disruptions is uneven and highly context-dependent. There is no universal protection. There are only relative differences in how various forms of value have behaved under stress. What is consistent is that claims fixed in a collapsing currency, such as long-term domestic bonds or domestic cash savings, have historically experienced the largest real losses. These are not predictions. They are recurring historical observations. We began with a paradox. Currencies are designed to be stable, yet history shows that many are not. When monetary systems change, the transformation is rarely announced in advance. It unfolds gradually through prices, contracts, and confidence. Across financial history, value has not disappeared. It has shifted from one form to another, from one unit of account to another. Precious metals, foreign currencies, and productive assets have often adapted in ways that fixed nominal claims could not. The contracts were honored. The numbers were paid, but what those numbers represented changed. In Tatsense, monetary collapse is not only a story of loss, it is a story of transformation, of how value migrates within financial systems under stress. And for those who study financial history, these patterns are not hidden. They are written clearly, across decades, across countries, and across systems. If this perspective added context to how money behaves under pressure, consider subscribing to Archive Financial.